If you're an Aussie first home buyer heading into 2026, this video could genuinely save you months of frustration, tens of thousands of dollars, and a whole lot of stress. Because winning as a first home buyer in 2026 isn't about luck, timing the market perfectly, or having help from your parents. It's about preparation, understanding the rules of the game, and putting yourself in the best position. In this video, I'm going to walk through exactly how first home buyers can get that first step onto the property ladder. Before we get into it, I'm Nick. I'm a mortgage broker with Kingfisher Finance Group, and I specialize in helping first-time buyers and investors get into the property market and structure their loans in a way that actually supports their long-term goals. Let's start with the most important piece, and the one that a lot of people get wrong. Before you even think about open homes, auctions, or scrolling through listings, you need to start with a real borrowing power number. Not a guessing game, not an online calculator, a real servicing based number. One of the biggest mistakes first home buyers make is house shopping emotionally before they've done the financial groundwork. They look at what their friends bought, what the bank's website says, or what a lender told them years ago, and they assume that's their budget. Then they fall in love with a property only to find out later that the bank doesn't agree. In 2026, it's even more important because servicing rules are still tight, buffers still apply, and the lenders are still conservative about expenses and liabilities. A proper borrowing capacity check means looking at your income in detail, not just your base salary. It includes overtime, bonuses, commissions, casual income, and how consistent that income has been. It means reviewing your living expenses honestly, because lenders absolutely do. It means factoring HEX debts, credit cards, buy now, pay later accounts, personal loans, car loans, dependents, and even things like child support. It also means stress testing your repayments. A lot of buyers still get caught assuming today's interest rates will last forever. Interest rates are always changing, so banks assess your loan at a much higher rate than what you actually pay to allow for any possible interest rate rises in the future. If you can only afford repayments at today's rate with no buffer, you will not be able to borrow as much as you may have thought. Let's say you've looked at your budget and have $3,500 per month that will be available to pay your mortgage. You may use some online calculator and see that a $600,000 mortgage at today's interest rate is around $3,400 per month. You may think that this means you can afford a mortgage of $600,000, but the banks would disagree. In reality, the banks apply a 3% buffer to your interest rate, resulting in that $600,000 loan being assessed at a repayment of about $4,600 per month. This means you would need to have an extra $1,100 per month to qualify for the loan you thought that you could afford. This is where working with a mortgage broker can make a huge difference. A good broker doesn't just tell you a number, they show you how to improve that number right away. That might mean reducing credit limits, even if you never use them, cleaning up buy now, pay later accounts that quietly kill your borrowing power, reviewing living expenses so they're realistic but not inflated, restructuring debts so repayments are lower, and choosing lenders whose policy actually fit your situation instead of just applying blind. If you want to go deeper on this, I've got a full video on how to increase your borrowing capacity in 2026. I'll link that down below. Once you understand your borrowing power, the next step is finding out exactly which government schemes you're eligible for. This is one of the biggest advantages first home buyers have going into 2026, and it's something investors and repeat buyers simply don't get. The Australian government's 5% deposit scheme, formerly called the First Home Guarantee, allows eligible buyers to purchase with as little as a 5% deposit and avoid lender's mortgage insurance. For a lot of buyers, this is a difference between buying now and waiting years, but the scheme is not eligible or suitable for everyone. You need to check whether you're eligible based on your residency status, whether you're a first home buyer or eligible single parent, and whether the property price falls under the price cap for your area, as well as some other eligibility criteria that you need to check. You also need to move early. You should have your scheme placement and pre-approval sorted before you start looking at properties. Waiting until you found a property before checking eligibility often means missed opportunities or unnecessary delays. It's also important to understand that the rules have changed recently. From October in 2025, access has broadened and price caps have increased in many areas. That means some buyers who weren't eligible before now are. But it also means increased competition in the market. And we've already seen this increase in buyer competition drive prices higher in certain price brackets and suburbs. On top of the federal scheme, there are also state-based schemes and concessions across Australia, and these differ significantly depending on where you're looking at buying. Knowing exactly what applies to you can change your strategy completely. Now, a quick but important point about these grants and concessions. Yes, you should absolutely use every grant or concession you're eligible for, but you should not build your entire plan around them. For example, in Queensland, there's a first home buyers grant. Eligibility depends on whether your property is new or established, there's value caps, and there's residency rules. Treat grants as a bonus and not the foundation of your plan. And never buy a property just to get a grant. Building a new home purely for the grant may not be the best option for your lifestyle, timeline, or finances. Once you know your borrowing power and your scheme eligibility, you can build a deposit plan that actually targets speed and competitiveness, not just saving for the sake of saving. A lot of people think that the goal is simply to save as much as possible. In reality, the goal is to save the right amount for the right strategy. Understanding your borrowing capacity and government scheme eligibility should give you a very clear idea of your realistic price range and the deposit that you actually need. From there, you can set a deposit goal that's tied to real suburb prices. It's also critical to keep your funds clean. Lenders care about savings history. They want to see genuine savings, not just a lump sum that appeared overnight. If you're receiving gifted funds from family, that's fine, but it needs to be documented properly and explained upfront. You also need to budget for upfront costs. Stamp duty where applicable, conveyancing fees, building and pest inspections, settlement adjustments, and moving costs all add up. Ignoring these can leave you short at the worst possible time. Once your deposit plan is clear, the next step is getting pre-approval early and keeping it alive. Pre-approval is not just about confidence. It sets a realistic price range, helps you move quickly when the right property comes up, and signals seriousness to agents and sellers. But it's not a guarantee. After you get pre-approval, you need to protect it. That means not changing jobs unless absolutely necessary, not taking on new debt, not opening new credit accounts, and not suddenly increasing discretionary spending just because you feel closer to buying. Another important point here is that not all pre-approvals are created equal. Some banks issue system-generated pre-approvals that only do basic checks. Your borrowing capacity can change dramatically when the application is fully assessed later. A broker can help place you with a lender that offers a fully assessed pre-approval up front. That gives you far more certainty when it matters. Now let's talk about understanding your buying method, because this catches out a lot of first home buyers. Buying via private sale and buying at auction are very different processes, and the finance requirements are not the same. With private sales, conditions vary state by state, but you'll usually negotiate a price, conditions, deposit amount, and the settlement period. Finance clauses are also common, and timelines can be flexible. Auctions are completely different. When you bid at auction, you're buying unconditionally. There is no subject to finance. That means your finance needs to be rock solid, your deposit needs to be accessible, and your building and pest inspections done before auction day. One of the most common fail points I see is buyers who mentally plan to buy at auction, but whose finance is structured for private treaty conditions. Aligning your approval type and conditions with your buying method is critical. If you're wanting to buy a property at auction, it's important that your broker has thoroughly checked your finances and has strong confidence in your borrowing capacity. You should also walk into the auction with a set maximum price point and stick firm to it. This maximum bid should be based on both the property's estimated value as well as your borrowing capacity capabilities. Because remember, when you bid at auction, you're buying unconditionally. If you win, you cannot simply pull out without consequences. Next, let's talk about how to make your offer more attractive without overpaying. In a market where many commentators expect prices to continue rising through 2026, winning buyers are not always the ones who offer the highest price. They're often the lowest friction buyers. That means shortening finance timeframes where it's safe to do so, being flexible on settlement if it suits the vendor, and having your conveyancer ready to review contracts quickly. It's also helpful to understand what the seller actually cares about. Sometimes a clean offer with fewer conditions beats a higher price with uncertainty attached to it. Knowing how to structure an offer strategically can make a huge difference. This is another scenario when using the right lender is critical. Some lenders grant approval within days, whereas some can take weeks. If you're putting in offers with tight finance clauses or even none at all, you want to have full confidence with receiving a fast approval. If you want to be a step ahead of the rest of the competition, make sure you have a pre-approval ready with a lender that can offer a quick approval. Finally, an important point is to understand all your options. If your borrowing capacity is lower than expected, it doesn't necessarily mean you're locked out of the market. For example, in some cases, buying an investment property can actually result in a higher borrowing capacity because the rental income is included in your servicing. And if you can't afford to buy in a suburb that you want to live in, rentvesting is another option, where you buy in an area you can afford and rent where you want to live. I've done a full video on rentvesting and I'll link that down below. There are also strategies like using a guarantor if you don't have a large enough deposit or you're ineligible for the 5% deposit scheme. The key point is this: if you've been told by a bank that you can't buy or you believe you have no options, it pays to speak to an expert who can show you all the pathways available and point you in the right direction. Now, before we wrap up, let's quickly run through some of the common mistakes first home buyers should avoid in 2026. One of the most common mistakes first home buyers make is shopping for properties before setting a servicing based budget. Many buyers start with online calculators, rough estimates, or what they feel like they can afford. Then they attend open homes and emotionally commit to a property that sits outside what a lender will actually approve. This creates unnecessary stress and disappointment when finance falls through or the budget has to be revised downward. A servicing based budget, calculated properly using your financial situation, gives you a realistic price range and ensures you're shopping with confidence instead of hope. Another major misunderstanding is assuming that pre-approval means unconditional approval. In reality, pre-approval is only an initial assessment and is still subject to valuation, updated documentation, and a final review of your financial position. Many buyers are caught out when their spending changes, their credit limits increase, or the bank's valuation comes in lower than expected. And as mentioned, some lenders issue system-generated pre-approvals that are not fully assessed by a credit team. These approvals often only check basic details and can change dramatically once the loan is reviewed in full. Waiting for the perfect interest rate is another mistake that continues to hold buyers back. While rates will always move over time, trying to wait for the lowest interest rate often means missing out on opportunities while prices continue to rise and competition increases. In tight supply conditions, especially in capital cities and high demand suburbs, buyers who wait too long can find that any benefit from a lower rate is far offset by higher purchase prices. Having a solid buffer and a sustainable repayment plan is often more important than locking in the absolute lowest rate. Credit limits are another area that many first home buyers underestimate. Even unused credit cards and buy now pay later accounts reduce borrowing power because banks assume that they could be fully drawn at any time. Leaving multiple cards open just in case can significantly reduce how much you're able to borrow. Reviewing and reducing unnecessary credit limits before applying can make a meaningful difference to servicing. Many buyers also underestimate the true cost of owning a home. Beyond the purchase price, there are settlement adjustments, conveyancing fees, inspections, insurance, strata or body corporate fees, ongoing maintenance, and moving costs. Failing to account for any of these can leave buyers stretched out or forcing to dip into emergency savings immediately after settlement. Similar to this, buying with no financial buffer is another risky move, especially given ongoing uncertainty around interest rates. Lenders assess loans with buffers for a reason, and buyers should do the same. Having spare cash after settlement helps absorb rate changes, unexpected repairs, or temporary income disruptions. Finally, many first home buyers assume government schemes apply automatically or that they'll qualify without checking the details. Schemes like the 5% deposit scheme have strict eligibility criteria, lender participation rules, and property price caps. Not using these schemes correctly or assuming that you'll automatically qualify can derail an otherwise solid plan. So make sure to understand the rules early so you can structure your strategy around them. If you avoid these mistakes and follow the steps we've talked about today, you put yourself in a far stronger position than most buyers you'll be competing against. If you found this helpful, make sure you subscribe for more first home buyer and property education. If you want a personalized strategy, reach out and book a chat. And you can check out the videos linked below that go deeper into borrowing capacity and rent vesting. Thanks for watching, and I'll see you in the next one.